There's a phrase that shows up right before almost every financial disaster in history. 4 little words. This time it's different. And here's the thing about those words. Every time a market convinces itself of that, it's usually about to learn, in the most expensive way possible, that it never is. So let me tell you about a crash you've probably never heard of. Not the dot-com bust. Not 2008. Not the Great Depression. This one gets talked about far less, even though in some ways it was more brutal than all of them. When it hit, the market lost around 80% of its value. Some of the most admired companies on Earth were gutted. And the truly staggering part? It took more than 3 decades for that market to climb back to where it started. An entire generation of investors bought in near the top and simply never made their money back. This is the story of the Japanese bubble. And by the end, I think you'll agree it's very similar to what's happening today. To understand how insane this got, you have to understand how good things felt in Japan in the 1980s. After the Second World War, Japan didn't just recover, it went supersonic. Within a few decades, it had gone from rubble to being the second largest economy on the planet. Japanese cars were beating Detroit. Japanese electronics were in every living room in the world. Sony, Toyota, Panasonic. These weren't just companies. They were symbols of a country that seemed to be doing capitalism better than the people who invented it. And the confidence that came with that was something else. There were genuinely popular books at the time with titles like Japan as Number One. People, both inside and outside the country, started to believe Japan's economic model was simply superior, that the usual rules didn't apply, that the good times were less of a cycle and more of a permanent setting. You can probably already feel where this is going. Then in 1985, someone poured petrol on the fire. 5 countries signed an agreement called the Plaza Accord, which pushed the value of the Japanese yen sharply upward. That was great for buying things abroad, but it hammered Japan's exporters. So to cushion the blow, the Bank of Japan did what central banks do. It slashed interest rates to rock bottom. Suddenly, money was almost free. And when money is that cheap, people don't just spend it. They speculate with it. What happened next is one of the wildest manias in financial history. That flood of cheap money poured into 2 places, the stock market and property. And both went absolutely vertical. Let's start with the land, because it's almost hard to believe. Tokyo real estate got so expensive that at the peak, prime commercial space was selling for around $139,000 per square foot. That's not a typo. It was said that the grounds of the Imperial Palace in central Tokyo were worth more than all the real estate in the entire state of California. Now, whether that was literally true or a bit of an urban legend, the fact that it was even a believable claim tells you everything. The whole country, an island roughly the size of California, was supposedly worth around 4 times more in property than the entire United States. It got strange in ways that are almost funny. Golf club memberships became financial assets. People traded them like stocks, borrowed against them, and some changed hands for millions of dollars each. There was literally an index tracking golf membership prices the way we track the S&P 500. And the mechanism underneath it all was this beautiful, dangerous loop. Rising land prices made companies that owned land look richer, which pushed their share prices up, which made them look richer still, which they then borrowed against to buy more land and more shares. Property lifted stocks, stocks lifted property, and round it went. On the way up, a feedback loop like that feels like genius. Everyone's getting richer, and it looks like proof the whole thing is working. The problem is that a loop that spins you upward spins exactly as fast in the other direction once it breaks. But the stock market is the part that matters most here. Japan's main index, the Nikkei, went on a tear that makes even recent tech rallies look tame. Japanese stocks and land values roughly tripled between 1985 and 1989. At the end of 1989, the Nikkei hit an all-time high of nearly 39,000 points. To give you a sense of the dominance, at one point more than half of the 20 most valuable companies in the entire world were Japanese. And just like every bubble, the valuations stopped making any sense at all. Investors were paying prices that only worked if these companies grew flawlessly, forever. Sound familiar yet? Here's the rule that never changes. The higher and faster something climbs on nothing but belief, the harder it falls when that belief cracks. And in Japan, the belief cracked at the worst possible moment, right at the peak of the confidence. The Bank of Japan, worried about how insane prices had become, started raising interest rates to let some air out. But you can't let a little air out of a bubble this size. You either leave it alone or you pop it. They popped it. The cheap money that had inflated everything suddenly wasn't cheap anymore, and the whole thing started to unravel. On the very last trading day of 1989, the Nikkei touched its peak. It would not see that level again for a very, very long time. In the 7 months that followed, the market fell around 45%. But this is the crucial part, the part that makes Japan different from a normal crash. It didn't bottom out and bounce back. It kept bleeding, slowly, for years. The market didn't didn't hit its true low until 2003, and from peak to trough, it had lost roughly 80% of its value. The property market went down with it, and Japan's banks, which had lent fortunes against wildly overpriced land, were suddenly sitting on mountains of loans that would never be repaid. What followed became known as the Lost Decade, though honestly that name undersells it, because the pain stretched well beyond 10 years into what people now just call the Lost Decades. Growth flatlined. Prices actually started falling and kept falling, and a country that had been utterly convinced it was invincible spent the next generation cleaning up the mess. Now here's the number I want you to really sit with, because a crash is one thing. Every market crashes eventually. What matters is how long it takes to heal. After the 1929 Wall Street crash, the one that caused the Great Depression, the American market took around 25 years to fully recover. That was, for the longest time, the benchmark for financial catastrophe. Japan blew right past it. The Nikkei did not reclaim its 1989 high until February 2024. That's over 3 decades. Longer than the recovery from the Great Depression, and a record for a major market. Think about what that actually means for a real person. Imagine investing your savings in 1989 at what looked like the safest, strongest market on earth, buying the most admired companies in the world. You would have waited until you were old and gray, more than 30 years, just to break even before making a single yen of profit. Not a lost decade for that investor. A lost lifetime of compounding. That is the real cost of buying into a story at the top. So why dig up a decades-old crash on the other side of the world? Because Mark Twain supposedly said history doesn't repeat itself, but it does rhyme. And parts of this story are rhyming loudly right now. Look at the ingredients that inflated Japan. Years of extremely cheap money and low interest rates. A powerful story that a handful of world-beating companies had rewritten the rules. Valuations that only made sense if those companies kept growing forever. And a deep, comfortable belief that this time really was different. Now look at today's market and tell me none of that feels familiar. The specifics change every time. The country, the industry, the decade, the technology at the center of it all. But the emotional shape of the thing is almost identical. Cheap money finds an exciting story. The story pushes prices up, rising prices seem to confirm the story, and confirmation pulls in the next wave of buyers who don't want to be the ones left out. Today, a small handful of giant technology companies, the ones people call the Magnificent Seven, make up around a third of America's entire S&P 500. 7 companies carrying the weight of the whole index. They are, without question, brilliant businesses. But so were Sony and Toyota and Panasonic in 1989. Being a great company has never been the same thing as being a great investment at any price. The Nifty 50 investors of the 1970s learned that. The Japanese investors of 1989 learned that. The question is always the same. Not, are these good companies, but what am I paying for them and what happens if the story wobbles? And to be fair, there are real differences. Today's tech giants make enormous, genuine profits in a way some bubble companies never did. This isn't a prediction that a crash is around the corner, and it's certainly not us telling you what to do with your money. Japan's story isn't a forecast. It's a mirror, because if there's one lesson that echoes out of Tokyo across all those decades, it's this. The most dangerous moment in any market isn't when everyone is scared. It's when everyone is certain. When a story becomes so widely believed that questioning it feels almost foolish. That's the exact moment the ground is least stable. Japan was the richest, most confident, most admired market on the planet. And the thing that hurt investors most wasn't a war or a disaster out of nowhere. It was 4 quiet, expensive words that a whole country had let itself believe. This time, it's different. It never quite is. And the more you understand why, the harder you are to catch out. If you'd like more of these forgotten corners of financial history, the ones that explain the present better than the headlines do, stick around. We're just getting curious.